Okay, so let's start. We want to start a new topic. And our topic is called accounting for deferred tax. That's the topic we want to start on now. So allow me to introduce it. Now listen. This is not totally a new topic to you because you must have done it in financial reporting. It's not totally a new topic to you. You must have done it in financial reporting. 2, there are some terms I'm going to use which you have already done in taxation. Now let me start. You all know that when you as an accountant, you prepare your financial statements, especially the income statement, you normally get what we call the accounting profit. Let me assume that you got a profit of 800,000. When you submit this profit to the tax authority for them to tax you, obvious you know they will not tax you on 800. You know that. What the tax authority will do, they will compute what we call the taxable profit. And it is on that profit that they are going to tax you on. So we can start even by saying that from an accountant's point of view, there are these two types of profit. There is what we call the accounting profit, and there is what we call the taxable profit. Accounting profit, I'm not hearing. Somebody is saying is not hearing. Okay, so we are saying the accounting profit is that profit on which you computed based on the normal accounting principles and concepts. Accounting profit is that profit which is based on the normal accounting principles and concepts. That is what we normally say. In other words, is the profit that is normally presented to the shareholders. The profit that is normally presented to the shareholders, that is the profit we call the accounting profit. But the profit on which tax will be based on for tax purposes, that profit is what we call the taxable profit. Now, good. From your tax knowledge, you know that to compute the taxable profit, the taxman will take your accounting profit. He will normally add back to that profit, he will add back what we call the disallowable expenses. Whatever they are, the taxman will normally add back what we call disallowable expenses. We shall remind ourselves in a short while. Once you get the disallowable expenses and you add them to the accounting profit, from there you all know that the taxman will normally deduct what we call allowable expenses, whichever they are. Once they minus, they get now this profit we call the taxable profit. That is generally how we normally compute what we call the taxable profit. They take the accounting profit, you add back the disallowable expenses. Let me explain one of them. Disallowable expenses are those expenses that you as a businessman, you have charged them in your income statement. But for tax purposes, they should not be recognized as expenses. So the taxman says you should not recognize it as an expense. Don't forget, we are computing the taxable profit, and we are now looking at this computation. Listen, we are looking at this computation from the taxman's point of view, not from the businessman's point of view. We are computing the taxable profit from the taxman's point of view. So when he takes my accounting profit, he will go through my income statement. He might find an expense in my income statement, which according to the tax rules, I should not have charged that expense. What will he do? He will argue by saying, by me including it in my income statement, I overcasted my expenses. I overcasted my expenses. When expenses are overcasted, obvious profit is undercasted. When expenses are overcasted, there is an expense I've included, me as a businessman, in my income statement, but as per the tax rules, I should not have included it. So from the taxman's point of view, he will consider that expense as a disallowable expense. Then we are asking ourselves, what effect did it have on our profit? From the taxman's point of view, means from the taxman's point of view, it means from the taxman's point of view, my expenses are overcasted. And when expenses are overcasted, automatically profit is undercasted. What will the taxman do? He will take my accounting profit and add back that disallowable expense, which I know for now. You can give me one example. One of them is obviously depreciation charge for the year. You all know that depreciation charge is not an allowable expense according to the tax authority. No. The income tax authority, they consider it as a disallowable expense. Good. But you all know that according to the income tax authority, in place of depreciation, they normally recognize, what we call wear and tear, or what we call capital allowance, For example, if you bought a machine at a cost of 1 million, and you as a businessman, your policy was to depreciate it over a useful life of 5 years, then it means every year you are charging 200,000. But for tax purposes, the taxman might give you what we call capital allowance on this machine at a rate of 25%. So according to the taxman, he says you should, according to the taxman, he says you should recognize what we call capital allowance of how much? 25% of 1 million is 250. Listen. So according to the taxman, I should have recognized an expense called capital allowance. But did I recognize it? No. Because I knew depreciation. Taxman says it should not be there. What should be there is capital allowance. When I give him the profit of 800, what will he argue? He will argue by saying, listen, that I have not included, another expense called capital allowance in my income statement, which of course I'm not going to include. But he will argue by saying, I have not included. By not including it in my income statement, the taxman will argue that my expenses are undercasted. From his point of view, he will argue by saying my expenses are undercasted. It is obvious when expenses are undercasted, profit is normally overcasted. So when I give him this 800,000 shillings to tax me on, he will not tax me on 800. He will now say that profit is overcasted. Why? Because your expenses were undercasted. You did not include capital allowance. So your expenses are undercasted. When expenses are undercasted, obviously profit is overcasted. So he will come and give me what we call capital allowance as one of the allowable expenses. So the taxman will recognize it as an allowable expense. That is capital allowance. That's one of the allowable expenses as per the income tax authority. Another example. You as a businessman, whenever you anticipate to make a loss, the rules of accounting says you provide for that loss. You provide that loss. In other words, you make a provision. For example, when you anticipate that some of your debtors are likely not to pay you, it is prudent that you as a business, you make a provision bad debts. You make a provision bad debts. So, when you made that provision for bad debts, listen, you also know from your tax knowledge, you all know that general provisions are not recognized for tax purposes. General provisions are not recognized. The taxman will normally wait until that loss becomes what we call specific. But you, from your accountant's point of view, the moment you anticipate to make a loss, you are required to provide. When you anticipate to make a loss, you provide. What did you do as a company this year? You made a provision for bad debts. From the taxman's point of view, should you have recognized it? No, you should not have recognized it. Therefore, the taxman will argue, saying, within your income statement, there is an expense called provision for bad debts. There is an expense called provision for bad debts. According to him, it should not be there. So how will he argue? He will argue by saying that my expenses are overcasted. My expenses are overcasted. It's obvious again. When expenses are overcasted, profit is undercasted. The taxman will come and now add back that provision for bad debts. Provision for bad debts. To the taxman, it is a disallowable expense. Good. Because he only recognizes losses when they become specific. But you, from the accountant's point of view, you normally make a provision whenever you anticipate. Good. Another example. You also know from your tax knowledge that if as a business you give a donation, for example, to a political party, if you give a donation to a political party, the taxman will never recognize that donation as an expense. He will never recognize it as an expense. But you, when you gave that donation, you recognized it in your income statement as an expense. So the taxman again will argue by saying, you as a business, you have included donation in your income statement and you should not have included. The taxman will argue by saying again, my expenses as per him, they are overcasted. Again, when expenses are overcasted, obvious profit is undercasted. So he will add back the donations as another disallowable expense. Before I give another one, let me give an illustration here. And for this illustration, I want to take you back to your financial accounting class when you started accounting. In financial accounting, you did a topic called company accounts. Given that, in your financial reporting, you did a topic called published. And in that topic, company accounts or published accounts, you could have been given. You normally are given a trial balance of this nature. Suppose you're given a trial balance of this nature, and in that trial balance, you could be given 10% debentures. Could be given 10% debentures amounting to 500,000. Assuming that's all in the trial balance. Listen. When you were required to prepare an income statement, you are given a trial balance of this nature and you are required to prepare an income statement. The question is, in that income statement, were you charging in that P&L account? Were you charging interest on debentures? Were you charging interest on debenture? Don't want you to answer me. I know you still can remember your accounting principles. It's obvious. Listen, it is obvious. You know. When you're a company, when a business, whichever form of business, whether a sole trader or partnership, whatever, whenever they prepare their financial statements, they follow what we call accrual concept. They follow what we call accrual concept. What does the accrual concept state? Accrual concept says that as a business, you should recognize costs when they are incurred. You recognize costs when they are incurred, but not when they are paid. You recognize a cost when it is incurred, but not in the year when it was paid. Listen, according to this trial balance, you as a company, you are supposed to pay your debenture holders interest every year at the rate of 10%, which according to this illustration, you should pay them every year 50,000. Whether you have paid it, listen, whether you have paid it or not, the income statement doesn't care. In other words, when I'm preparing my income statement, I have to recognize a cost I've incurred. Not in the year it was paid, but in the year it was incurred. So this year I am supposed to pay my debenture holders interest of 50. So I'll still charge 50 in my P&L account, 50,000, which is 10% of 500. Listen, then when I'm doing my balance sheet, listen, when you as a company are doing a balance sheet, that's the time you normally have to ask yourself, do I owe the debenture holders anything? Do I owe the debenture holders anything? From this trial balance, it is obvious I have paid them nothing. And I'm supposed to have paid them 50, but I've paid them nothing. Listen, it means therefore, the whole 50,000 will go to the balance sheet of this company as a current liability, as being interest owing to be paid next year, as a current liability to be paid next year. Now my concern is here now. This is what you did as a company. This is what you did as a company. You charged 50,000 in your income statement, took the same 50,000 to the balance sheet as a current liability, obvious to be paid in the following year. Now listen, suppose the question tells you, for tax purposes, listen, suppose the question tells you, for tax purposes, interest is recognized. Interest is recognized on cash basis for tax purposes. Suppose the question tells you interest is recognized for tax purposes on cash basis. Now, will that cost, listen, will that cost the difference between my accounting profit and the taxman's profit? The answer is yes. How? This year, you as a businessman, you recognized 50 in your income statement. But the taxman says what? He recognizes it as an expense on cash basis. That means he recognizes it as an expense in the year it is paid. In the year that interest is paid, that is the year he recognizes it as an expense. So when will the taxman take it as an expense? Is it in the current year? No. When? In the other year when I shall actually pay it. Remember, I took it to my balance sheet this year as a liability. When will it be considered as a payment? It will be paid next year. That is the year the taxman will recognize it as an expense on cash basis. But you as a businessman this year, you recognized it as an expense on what basis? On accrual basis or accrual concept. It states that you recognize cost when it is incurred, but not in the year it was paid. Listen, when I give this tax profit of 800 to the taxman, when I give this profit of 800 to the taxman, will the taxman tax me on that 800? The answer is no. Why? Again, he will say, in your income statement, there is an expense called interest, which you should not have charged. Oh, again, he will argue by saying, my expenses, from his point of view, my expenses are overcosted. Oh, my expenses being overcosted, automatically from his point of view, my profit would be undercosted. So that interest which we are charging, interest on debenture, which is on cash basis, he will add it back. Why? Because according to him, I should not recognize it as an expense. According to the taxman, I should recognize it as an expense in the year it was paid. But because of my accounting rules, says I recognize it on accrual basis, I had to recognize it. That's another example of what we can classify as disallowable expenses. So I've given you a few examples of disallowable expenses. For now, I want to assume only one example to be a allowable expense, and that is capital allowance. Okay, good. Now listen. So now you know how we shall be computing what we call the taxable profit. But sometimes the examiner would normally require, before you compute deferred tax, it would require you compute the taxable profit. I've said to compute the taxable profit, we shall be taking the accounting profit. You add back all the disallowable expenses as per the question, then you minus the allowable expenses, then you get what we call taxable profit. Listen, it is on this taxable profit that the taxman will calculate the tax I'm supposed to pay him this year. Listen, on that profit, let us assume he gets 700,000. It is on this 700,000 that he will require I pay tax on it. Listen, the tax amount that he requires me to pay this year, that tax amount, we normally call it the current tax, or what you could call corporation tax. That means to compute the corporation tax or the current tax, we take the taxable profit, you multiply that by the tax rate. Whatever is the tax rate on that 700,000, that becomes your current tax. When you are told to compute current tax, you have to first get the taxable profit. Once you get the taxable profit, you apply the tax rate on the taxable profit. Apply the percentage on the taxable profit. Before we continue, we need to put down something on what we have already said. Before we continue, discuss how to compute the taxable profit. I've told you what's a taxable profit. Is the profit on which tax will be based on tax purposes. Profit on which tax will be based on for tax purposes, that's what we call the taxable profit. What's accounting profit? It is the profit which is computed based on the normal accounting principles and concepts. Okay? Then I've said it's the same profit that is normally reported to shareholders. We have said normally the two profits normally would differ. We have given a few examples of the causes why the two profits will normally differ. Good. So with that idea now, we want to put down something. Again, listen, before we put what I want us to put, before I put down what I want us to put down, again, listen, there are some new students who have joined us. Please allow me to tell them also. For the others, you already know this. But for the new students who have just joined us, let me allow them. Let me say this for the new students. I know there are those who have joined the class. Now listen. For the new students, please, if you have not subscribed to my YouTube channel, please subscribe by clicking that subscription button. By clicking that subscription button so that you'll be notified whenever we post new videos into the YouTube. You can even subscribe even as you're watching this video. Just click on that subscription button below there. You can even go ahead and click the notification bell. Click the subscription button and you also click the notification bell so that you will be notified whenever we post new videos into YouTube. Okay? Now, also, for the new students, because I've told this the other students, the new students who have just joined us, if you have friends who would want to do online classes, tell them that we are offering online classes for advanced financial reporting. We are also offering online classes for financial reporting and for financial accounting. Those are the three papers we are currently offering online classes on. Advanced financial reporting of the advanced level, financial reporting of the intermediate level, and financial accounting of the foundation level. And thank you, Oscar. Thank you, Oscar. Oscar's case already subscribed. Thank you. Financial accounting of the foundation level and that of ATD level 1 and ATD level 2. They also have financial accounting there. Good. For financial accounting, the advanced one, normally we have either early morning classes. Early morning, we always have early morning classes, or you can have evening classes. We have early morning. Our early morning starts normally from 5:30 in the morning to 7. Our evening starts from 8 p.m. to 10 p.m. Okay. Our financial reporting normally is in the evening. It's normally in the evening. Okay. Then, listen. For those of your friends who can't be able to join the live classes, that is for any of the subjects, you can tell them that we also have what we call pre-recorded videos. We also have what we call pre-recorded videos where they can get the videos for the whole syllabus and watch them at their own free time. Good. For any of the subjects, somebody can call me. Tell them they can call me on this number, 0722 65 8875. 0722 65 8875. That's the number they can reach me if they want to reach me for any information. Currently, we are charging 4,200 and we normally accept payments on installments. If you join the live class now, you will get the videos of all the previous classes. If you join the online classes now, you will get the videos of all the classes that we've already covered up to now. Okay? Don't panic. And if you join now, tell them that they can still get the videos of the classes we have already covered. I think that's all I can say for now. Let me continue now. Allow me to continue with our topic. We were just about to write something. We're just about to write something down. Unless I've forgotten something, I've told you. The new students, please subscribe. Then blah, blah, blah about your friends, about our online classes. Good. Now, let's continue now. So we were to write something down. So put down the topic now. Put down the topic. Topic is accounting for deferred tax. The topic is accounting for deferred tax. Topic is accounting for deferred tax. Accounting for deferred tax. Then you say this. Accounting for deferred tax. Accounting for deferred tax. And you say this. From an accountant's point of view, there are two distinct profit figures. From an accountant's point of view, there are two distinct profit figures. There are two distinct profit figures. One, accounting profit. One, accounting profit. And you can say this, accounting profit, then you say this. This is the profit. This is the profit. This is the profit that is based on. This is the profit that is based on the normal accounting principles and concepts. This is the profit that is based on the normal accounting principles and concepts. This is the profit that is based on the normal accounting principles and concepts. Stop, continue. It is the profit, continue. It is the profit that is reported to shareholders. It is the profit that is reported to shareholders. Profit that is reported to shareholders. Number two, taxable profit. Taxable profit. Taxable profit. Taxable profit. This is the profit. This is the profit on which tax will be based on. This is the profit on which tax will be based on for tax purposes. This is the profit on which tax will be based on tax purposes. This is the profit that this is the profit on which tax will be based on for tax purposes. Tax purpose. And you say this, it is the profit on which the amount of the current tax is the profit on which the amount of the current tax is computed. Is the profit on which the amount of the current tax is computed. And it is calculated as follows. 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 So we come and show as if we are doing the workings. I'm not rubbing everything. I'm not rubbing everything because almost everything is okay. So just come and say here accounting profit, whatever it is that you will be given. Then you add back the disallowable expenses. We have listed a few and copy them. One of them being depreciation charge for the year. Whatever is the depreciation charge. The second one is what we are calling provision for bad debts. Third one is what we are calling donations. Fourth one is what we are calling interest on debentures on cash basis. Interest on debentures on cash basis. Interest on debentures, it could be interest on loan, interest on debentures on cash basis. For now, we have assumed those are the only ones. Now we have assumed those are the only ones. Get the net, you push it to the extreme. Get the total of those allowable, push it to the extreme. Then get the totals, then you come and less allowable expenses. For these allowable expenses, we have used one as an illustration. And the only one for now is what we are calling the capital allowance. Once you minus that, whatever you get now is what we are calling the amount of the taxable profit. The amount of the taxable profit. Good. Once you get that amount of the taxable profit, below there, now you can put something like this. Below there you can say current tax. Current tax is equals to tax rate times the taxable profit times the taxable profit. You can put down that current tax is equals to the tax rate times the taxable profit. Good. Finish now. I want to develop the topic now. That's what we have covered so far. That's what we have covered so far. Finish. I want to develop the topic now. Okay, now listen if you're through with the copying. Now listen if you're through with the copying. Listen. Though I have mentioned a few examples of disallowable expenses and one example of allowable expenses, listen. You have done taxation, and so you obviously know from your knowledge of tax that these are not the only causes why the accounting profit is different from the taxable profit. From the Income Tax Act, you know there are several other causes. But for now, we have assumed those are the only ones. Now listen. Of all those causes, whatever they are, whether it's depreciation, capital allowance, donations, and many others that we have not mentioned. Listen, all those causes, why the two profits normally differ, listen, of all the causes, all of them, whether allowable or disallowable, all of them can be classified into two categories. Why the accounting profit differs from the taxable profit, the reasons why the two differ, those reasons can be classified into two categories. One is what we call the timing, or what we can call the temporary difference. That's one reason why the two may differ, the temporal difference. The second reason why the two profits may differ would be because of what we call the permanent difference. Permanent difference. Let me explain them. I have said, of the many, I remember when we were doing tax, the list was too long for the causes, both allowable and disallowable. Said, all of them can be classified to be either timing difference, the cause would be because of the timing difference, or what we are calling permanent difference. Timing difference is also known as temporal difference. Let me give an illustration. I have just used an example for debenture interest here. And I told you, in this case, I charge 50 this year in the income statement, though I had not paid anything at all. I took the same 50 to the balance sheet as a liability to be paid when? The following year. Then I have told you, for tax purposes, it is recognized as an expense on cash basis. On cash basis. Now listen to my point. Me as a businessman, I recognized the 50 in the year I incurred it. It's this year, though I never paid it. I recognized it as an expense because of accrual concept. The taxman will not recognize it as an expense this year. He will recognize it as an expense in the year when it will be paid. When will it be? Next year. So, listen, so both of us, that is the business and the income tax authority, both of us are recognizing the 50 as an expense. The only difference is the timing. Therefore, my profit this year will never be the same as the profit this year for tax purposes. Because for tax purposes, according to him, I should not recognize an expense this year. I should recognize it next year. Me, next year, I'm not going to recognize it because I already recognized it. So our two profits will keep differing, not because we are not recognizing an expense. Both of us are going to recognize an expense. The only difference is the timing. So such a cause of the difference is what we classify as a timing difference. As a timing difference. Okay? Another example. You bought a machine at a cost of 1 million. Your policy as a company is to depreciate it on a straight line basis over 5 years. That means every year you will be depreciating it at 200 every year. The same machine, the taxman gives you what we call capital allowance. Let's assume at the rate of 25% per annum. So every year he recognizes 250 for 4 years. Yeah? That is how he'll consume. That's how he will consume 1 million. So both of us are going to recognize that 1 million as an expense. Both of us are going, me I'm calling it depreciation, taxman is calling it capital allowance, but both of us are recognizing it as an expense. The only difference is the timing. Me, I recognize the 1 million as an expense over 5 years. You, as the taxman, you recognize the same 1 million as an expense over a period of 4 years. 250, 250, 250. So it is obvious that our two profits this year, next year, and the 5-year period will differ. Why? Because of the timings. This year I recognize 200. You are rejecting it, but you are recognizing 250. Same. Next year, I recognize 200, you reject it, you recognize 250. Not that you are not going to recognize the 1 million. You are still going to recognize the 1 million. The difference is the timing. That's another example of what we can call a timing difference. Listen, so timing differences are those items that appear in the income statement in a period, listen, in a period different from the period in which they are recognized for tax purposes. If you recognize, like I talked about interest, I recognized it in the income statement this year, but for tax purposes, it will be recognized in a different period. Or depreciation, 200 this year, taxman recognizes 250 over 4 years. Me, 200 over 5 years. So we are saying timing differences are those items that appear in the income statement in a period different from the period in which they are recognized for tax purposes. Now, let me give another example. The other example we have given or we have used is donation. Suppose as a company, you gave a donation to a political party of whatever the amount. Listen, when you gave that donation, you recognized it as an expense. The question is this: the taxman is not recognizing it this year. That's why he's adding it back. But the question is, will he recognize it as an expense in the future? Will he recognize it as an expense in the future? No, not at all. So it is appearing in the income statement, but it is totally disallowable for tax purposes, not even in the future. Not even in the future. So it will cause a difference between our two profits this year. Why? Because yes, you have recognized, but you should not recognize. The taxman says you should not recognize. Will he recognize it in the future? No. We classify such a cost as permanent difference. This is an item appearing in the income statement, but which is totally disallowable for tax purposes, not even good. Now, before we continue, let's put down that point. Let's put down that point. Why the two profits may differ. Another paragraph, down this, another paragraph, MIV. The following are the reasons why. Following are the reasons why the accounting profit may differ taxable profit. Following are the reasons why the accounting profit differ taxable profit. Following are the reasons why the accounting profit may differ taxable profit. Number 1, timing stroke temporary differences. Timing stroke temporary difference. Timing stroke temporary difference. Timing stroke temporary difference. Then you put a dash. See this. See this. These are items appearing in the income statement. These are items appearing in the income statement. These are items appearing in the income statement in a period. These are items appearing in the income statement in a period different from the period. In a period different from period in which they are recognized tax purposes. These are items in the income statement in a period different from period in which they are recognized tax purposes. Items in the income statement in a period different from the period in which they are recognized tax purposes. Items in the income statement, period different from the period in which they are recognized tax purposes. The paragraph. Number 2, 2, permanent differences. Permanent differences. Permanent differences. Permanent differences. Permanent differences. Can you say this? Permanent differences. These are items in the income statement. These are items in the income statement. These are items in the income statement which are totally disallowable. Which are totally disallowable for tax purposes. Which are totally disallowable tax purposes. Not even in the future. Not even in the future. These are items in the income statement which are totally disallowable. Which are totally disallowable, not even in the future. Not even in the future. Another paragraph. A paragraph. Deferred tax. Deferred tax. Deferred tax arise. Deferred tax arise due to the existence. Deferred tax arise due to the existence of the timing differences. Deferred tax arise due to the existence of the timing differences. Deferred tax arise due to the existence of the timing differences. You know, permanent differences do not cause. Permanent differences do not cause deferred tax. Permanent differences do not cause deferred tax. Permanent differences do not cause deferred tax. Okay. I have not explained that point. It's the one I want to explain now. I've just added it there first so that we put it down. Then I explain how deferred tax give rise to, no, timing difference give rise to deferred tax. That's what I want to explain now. So in other words, we are now looking at how compute the second type of tax. That's what I want to demonstrate now. What is deferred tax? We have talked about what's current tax. Now we want to talk about what is deferred tax. Now allow me to demonstrate on how deferred tax arises because of the timing difference. I want to demonstrate first. Listen. As a company, this year you made a profit before tax of 800,000. You had bought a machine at a cost of 300,000. I want to use a simple illustration. It has a useful life of 2 years. Useful life of, yeah. For tax purposes, the taxman gives you a capital allowance of 100% in the first year. Taxman gives you capital allowance of 100% in the first year. Now listen. Suppose the tax rate is 30%. So if your accounting profit was 800, then it means that you as a company, you thought you will be required to pay 30% of 800. That looks like 240. But when you take this same profit to the taxman, that 800, will he tax you on that 800? The answer is no. He will compute what we have called the taxable profit. How will he compute? By adding back your disallowable expenses, which one of them is depreciation. We are assuming a simple case where I bought a machine at a cost of 300. Useful life is 2 years. Straight line basis, every year I'm charging 150. The taxman will add back 150 to my profit. He will get 950. Then he will give me a capital allowance. Give me a capital allowance. How much? 100% in the first year. That comes to 300. So this year, he will require that I pay him tax on how much? What is the taxable profit? That looks like 650. Good. At 30%, what will be the amount to be paid? 30%. What is 30% of 650? Let me calculate it. 30% of 650. Just a minute, sorry. That looks like 195. Let me go to the second year. Then I'll explain what I want to explain. Suppose in the second year, again, as a company, I made a profit of another 800,000. According to me, again, I thought 30%, I thought I'll be required to pay how much? 240. I took the 800 to the taxman, but he did not tax me on 800. he added back my depreciation, is 150. He got 950. Will he give me capital allowance in that year? The answer is no. Why? Because he gave me 100% allowance in the year 1. So in the second year, he will require I pay tax on 950. At 30%, he will require I pay tax of how much? 30% of 950, let's calculate it. That looks like 285. Now I have the data I want. Now listen to this now. While me as a businessman, I thought I'll pay tax of 240. The taxman told me, no, you're not going to pay him 240. I'm going to pay him 195. So I thought I'll pay 240. Taxman says pay him 295. There's a difference of how much? I pay him 195, while I thought I'll pay him 240. There's a difference of 45. Listen to my question now. Does it mean that I'm not going to be required to pay that 45? Does it mean that I'm not going to pay that 45? According to me, I thought I should pay 240, 30% of 800. But for tax purposes, the taxman says pay 195. Question is, does it mean I'm not going to pay him that 45? No. Listen, a time will come when I'll be required to pay more. You look at year 2, for example. Again, let's look at year 2. In year 2, I thought I'll pay 240. But for tax purposes, taxman is telling me to pay him how much? 285. While I thought I'll pay 240, now the taxman is saying pay 285. Meaning he's requiring me to pay him more than I thought I should pay. By an extra how much? By an extra 45. He's asking me to pay him an extra 45 in the second year. Now listen, going back to year 1. While I thought I'll be paying 240 in year 1, the taxman says, pay me 195. I paid him whatever he wanted. That's what I paid him. Which is how much? 195. The question is, does it mean I'm not going to pay him this 45? No. A time will come when I'll be required to pay more than I thought I'll pay. So what is the thing I should do now? I know in future I'll be required to pay more. But this year he wants me to pay less. See? So you as a businessman, it is prudent that you defer paying this 45 until a later date. You defer the 45 in year 1 until a later date. In other words, create a liability in your books now to be paid in the future. Because you know a time will come when the taxman will ask you to pay. Okay? So in that case, therefore, we are saying, create a liability now to be paid in the future. What do? You will open an account called deferred tax. To create a liability, we know a liability is always a credit balance. A liability is always a credit balance. So you will debit P&L account by end of year 1 and you credit deferred tax. How much? 5. That means you have deferred. Or in other words, you have transferred that 45 to the deferred tax. Either say you have deferred to pay 45, or we can say you have transferred the 45 to the deferred tax. Then by end of year 1, you will carry down the balance, which is 45. You will bring it down by the beginning of year 2, balance brought down, which is 45. Then you ask yourself, In the second year, what was the position? While I thought I'll pay 240 in year 2, the taxman now says, pay me how much? Pay me 285. So the question is, I am being required to pay more than I thought I should pay by an extra how much? 45. I'm being required to pay more by an extra 45. The question is, where will I get this extra 45 from? I thought I'll pay 240, but now I'm being required to pay 285. Where will I get this extra 45 from? It is a time now I go recall that 45. I go recall it from where I deferred. So in the second year, now you don't transfer to the deferred tax. Now you go transfer from the deferred tax. You recall that 45. You deferred it in the first year. A time has come when you are now required to pay it. Go and recall it. So in the second year, we say you have to transfer 45,000 from the deferred tax. You transfer from the deferred tax, you debit deferred tax by 45 and you credit P&L account. So this is a simple illustration on how deferred tax arises. Now, before I continue, if you look at those 2 years, listen, in the first year, I thought I'll pay tax of 240. But the taxman told me, no, you will pay him 195. Second year, I thought I'll pay tax of 240. 240 in the first year, another 240 in the second year. It comes to a total of 480. So I thought in total for 2 years, I thought I'll pay 480. What is the taxman's position? He required I pay him 195 and again second year, another 285. So for those 2 years, he will require I pay him how much? Let me calculate. What is 195 plus 195 plus 285? I get again 480. Good. 480. Now listen. While I thought I'll pay tax on 800 and on 800, those 2 years, the total is 1.6. 2 years, if I look at it as an overall position, I'm supposed to pay tax on 1.6 million. The taxman says, no, you're not going to pay me on that. You're going to pay me on 650 and again on 7,950. For those 2 years again, what amount of the total profit does he want me to pay tax on? It will be 650 plus another 950. That comes to a total of another 1.6. So you can see in the long run, the two positions remain the same. The only difference was because of the timing. The only difference was because of the timings. So I've tried to demonstrate how deferred tax arises. How deferred tax arises because of what we were calling the timing difference, or what you call the temporal difference. Told you permanent differences to give rise to deferred tax. This is a simple illustration on how to compute. Simple illustration on how to compute what we call deferred tax. Okay, now I want to develop further. We shall still come back to this. Now, there are normally two methods. Of determining deferred tax. One of them is the one I've already used. We call it the profit and loss approach. That's the one I've already used, where I compare profit as per the businessman with the profit as per the taxman. Total pay 240. Taxman says pay 195. I paid him whatever he wanted. Then I deferred another 45. Second year, Total paid 240. He says paid 285. Time has come when I'm required to pay more than I thought I should pay him because his profit was more. So that approach of computing deferred tax, call it the profit and loss. There is a second approach which we use compute deferred tax, and that's what we call the balance sheet, or we also call it valuation approach. And it's the one I want to talk about now. The one I want to talk about, how do we use this to compute deferred tax, which we are calling balance sheet or valuation approach. Let me introduce it. Now, as the name of course suggests, you use the balance sheet items. It's obvious the values in the balance sheet. Let me start with a simple illustration. As a company, you bought a machine, let's say at a cost of 100 million many years ago. You as a company, you have been depreciating it. Come the end of this year, you are remaining with a book value of 10 million. You are remaining with a book value of 10 million. That is the balance remaining in balance sheet, which of course is the amount that you're going to depreciate in the future. Okay? That amount, we normally call it the carrying amount of the asset. Carrying amount of the asset. Yeah? Good. That same machine that costed me 100 million, the taxman has been giving me a capital allowance at whatever rate. And again, for him, by end of this year, is remaining. By him, end of this year, according to the taxman, is remaining with a balance of 4 million. I am assuming that he has been giving me capital allowance at whatever rate. Come end of this year, he still has a balance of 4 million to give me as capital allowance in the future. While I'm remaining with 10 million in my books to provide as depreciation in the future, the taxman, according to him, he has a balance of 4 million to give me a capital allowance in the future. That 4 million, we shall be calling it the tax base. Shall be calling it tax base. Now listen. Suppose both of us, that means me as a business and the taxman, we are only remaining with 1 more year to go for this machine. We are remaining with only 1 more year to go. Suppose we are remaining with only 1 more year to go, which is next year. In other words, me next year, I'll depreciate my asset fully by 10 million, sorry. Then you as the taxman, you will give me a capital allowance of 4 million next year, all of it. What will happen next year? Suppose next year, listen, suppose next year I make a profit as a business, a profit before tax of 100 million. When I shall give this profit to the taxman, when I shall give it, it's wondering in the future, when I shall give it to the taxman, he will obviously not tax me on that 100 million. What will he do? He will add back my depreciation, which is how much? 10 million. He will get an amount of 110. Then he will give me a capital allowance of how much? 4 million. So that year, which is next year, he will require I pay tax on 106. He will require that I will pay tax on 106. Meaning there will be a difference between my profit and his profit by an extra how much? By an extra 6 million. He will require that I'll pay tax on 106. While I thought I'll pay tax on 100, he will tell me, no, you will pay me on 106. Listen. Meaning, from the taxman's point of view also, he will require I'll pay him extra tax on this 6 million in the future. While I thought I'll pay on 100, I'll also be required to pay on that extra 6 million. On that extra 6 million, I will also be required to pay tax on that 6 million also. Listen. So from the taxman's point of view, that 6 million, to him, it is still taxable. It is taxable. He will require that I pay tax on that 6 million also. So to the taxman, it is taxable. If you go back to our table here, I said the carrying amount of my machine, 10 million. The tax base, that means the value as per the taxman, is 4 million. If you compare this carrying amount of 10 million with the tax base of 4 million, you can see is a difference of 6 million. That 6 million is what we shall be calling the temporary difference. What we shall be calling the temporary difference. That's 6 million. Now listen. I have already told you, I know the taxman will require that I'll also pay tax on that extra 6 million. So to the taxman, that is taxable. That 6 million. It means I know that I'll be required to pay tax on that extra 6 million in the future. Listen to this now. That 6 million, we shall be calling it the taxable temporary difference. Shall be calling it the taxable or a taxable temporary difference. Listen. Now that I've said I'll be required to pay tax on it also, I know I'll be required to pay tax on it also. So what do I do now? I know in the future I'll be required to pay tax on that extra 6 million also. So what is the most prudent thing for me to do now? Listen, most prudent thing for me to do now is to create a liability on that 6 million now to be paid in the future. Listen, I am not saying create a liability of 6 million. No, it's not like the other approach where I was supposed to pay 240. Taxman says pay 295, 195. I paid him. So there was a difference of 45 he did not want me to pay. That one you deferred. Here, I thought I'll pay tax on a profit of 100. But he tells me I'll pay tax on a profit of 106. So there's this extra profit of 6 million, which I know I'll be required to pay tax on it also. So what is the prudent thing for me to do now? Most prudent thing for me to do now is to create a liability on that 6 million now, to create a tax liability. That 6 million now paid. When you have what we are calling taxable temporary difference, then you create what we call a deferred tax liability. You will create a deferred tax liability on that 6 million. Create a liability now, paid in the future. Let me use another illustration. Suppose you have another asset called motor vehicle. It costed you whatever it costed you. you have again been depreciating it, depreciating it, depreciating it, depreciating it. Come end of this year, you are remaining with a book value of 3 million. For tax purposes, the taxman has been giving you capital allowance on the same motor vehicle, from the same cost, whatever it was. By end of this year, is remaining with a balance of 4 million to give me as capital allowance in the future. What will happen in that future? That's what I want to look at. Again, suppose both of us are remaining only 1 more year to go. Next year, I make a profit of 100 million. Will he tax me on 100 million? No. Add back my depreciation. How much? 4 million. Is it 4? No, 3 million. That's my book value. You'll give me depreciation. You'll add back my depreciation of 3 million. You'll get 103. Then he will give me a capital allowance of 4 million. So next year, he will require that I pay tax on how much? 99. While I thought I'll pay tax on 100, the taxman will tell me, no, you're not paying tax on 100, you will pay tax on 99. Which is the same as saying, to arrive at his 99, you can see already there's a difference of 1 million. So to arrive at that 99, it is the same as just saying, he will take the profit before tax of 100, he will deduct 1 million. Come to 99. So that 1 million, we normally call it, a deductible temporal difference. Call it a deductible temporal difference. Now listen, if you go back to the table, we had a carrying amount of 3 million. The tax base of this motor vehicle, 4 million. I said, the difference between the carrying amount of an asset and its tax base is what we call the temporal difference. Here, you can see there is a negative 1. 3 minus 4 is negative 1. That's the same amount we have concluded down here to be what we are calling deductible. While I thought I'll pay tax on 100 in the future, the taxman will tell me I'll pay him tax on 99. Listen, meaning it's like I'm going to save in the future. It's like I'm going to save tax on 1 million. I'm going to save tax on 1 million. Or in other words, it is the same as saying, I am going to recover. In the future, I am going to recover tax on that 1 million. Not I'm going to recover 1 million, no. I'm going to recover tax on that 1 million in the future. What is the most prudent thing for me to do now? Because that is in the future. What about now? See? Most prudent thing for you to do now as a business is to create an asset now to be recovered in the future. You create an asset now to be recovered in the future. So on that 1 million, which we are calling a deductible, that 1 million, we are now calling it a deductible temporal difference. Why? I too have just illustrated. The taxman will deduct the 1 million from my profit. To arrive at his profit, he will have to deduct 1 million. That's why we are calling it deductible temporary difference. Okay? Say, in the future, I'll pay less tax. While I thought I'll pay tax on 100, taxman will tell me to pay tax on 99. I'm going to save tax on 1 million. Or in other words, I'm going to recover tax on 1 million. What is the most prudent thing for me to do now? Most prudent thing for me to do now is to create an asset now to be recovered in the future. To be recovered in the future. In other words, I create what we call a deferred tax asset. Create what we call a deferred tax asset. So I hope you are now seeing or getting an idea of how we normally use balance sheet or valuation approach to compute what we are calling deferred tax. Approach is where you compare the carrying amount of an asset or liability, because balance sheet includes liability. We compare the carrying amount of an asset or liability with its tax base. Then I've said the difference between the carrying amount of an asset and its tax base, that difference, we have called it temporary difference. We have called it a temporary difference. I have told you, temporary difference can either be taxable, like the 6 million, where I know I'll be required to pay tax on that extra 6 million. It's classified by the taxman. From the taxman's point of view, that 6 million is taxable. So what do I do now as a businessman? I create a deferred tax liability on that 6 million. Now, be paid in the. Then I will demonstrate the second one, whereby now, while you thought you will pay tax on 100, now the taxman says you will pay tax on 99. You're going to pay less tax, while you thought you're going to pay more. Means, it's like you're going to recover or to save tax on the 1 million. When I shall give him the profit of 100, we have seen, so for the taxman to arrive at his profit, he will simply take that 100, deduct the 1 million. That's why we are calling it a deductible temporary difference. A deductible temporary difference. Okay? But then, the issue is, I'm going to pay less tax in the future. Well, I thought I'll pay more. I'm going to pay less. I'm going to recover tax in the future. What do? I create an asset now to be recovered in the future. To be recovered in the future. Okay? Good. So you create a deferred tax asset. Good. That's how shall be using the balance sheet approach. I am not through yet. Today, I want to stop there. Next time, I want to stop there for now. Next time, I'll go on with the other items. We are not through with the balance sheet items. We shall go through the other remaining items as per the balance sheet. Today, I've only demonstrated using 2 items. That is machinery, vehicle. We shall go through the other balance sheet items on how to compare their carrying amount with their tax base. Then we compute what we are calling the temporary difference. Then we classify that temporary difference to be either taxable or deductible. We have agreed it's taxable. We call it, we create a deferred tax liability. If it's deductible, we create what we call a deferred tax what? Asset. Listen. Now, from your past papers, so far, I have answered several past paper questions on theory. I have answered several past paper questions on theory. You have been asked before, as per the income tax standard, number 12, define the following terms. 1, carrying amount. 2, tax base. 3, temporary difference. 4, deferred tax liability. Somewhere you are told deferred tax asset. So when you're told to define these terms, and to believe by now, through what we have said so far, I should not have a problem of defining these terms. Okay? By the way, when you are taught to define these terms, some students forget their definition and they use an example. They say temporary difference is where, for example, if the carrying amount of an asset is 10 million and its tax base is 4 million, then 6 million is the temporary difference. Is it correct? When you are told to define what's a temporary difference, and you say, this is whereby, for example, if the carrying amount of an asset is 10 million and its tax base is 4 million, therefore 6 million is the temporary difference. If you're asked, what's a deferred tax asset? What's a deferred tax liability? What's a tax base? What's a carrying amount? You should be able to define. For example, what's a carrying amount? Of course, we all know carrying amount is the amount at which an asset or even a liability appears in the books. The amount at which an asset or liability appears in the books, that's what we call carrying amount. What's tax base? Tax base is the amount on which tax will be based on for tax purposes. We shall put down the definitions later. But just for now, saying what's tax base? The amount on which tax will be based on for tax purposes. The taxman does not know my 10 million motor vehicle or furniture. No, he knows his 4 million for tax purposes. Yeah? Because he will reject my 10 million, he will give me a capital allowance of 4 million. So that's what he knows. Yeah? So the amount for which tax will be based on for tax purposes, that's what we are calling the tax base. What's temporary difference? Temporary difference, we have said, the difference between the carrying amount of an asset, the difference between the carrying amount of an asset or liability with its tax base. That's what we are calling temporary difference. The difference between the carrying amount of an asset or liability, its tax base. That's what we are saying, the temporary difference. You can even go further and tell the examiner, temporary difference can either be taxable or deductible. You can even go further and say, taxable temporary difference creates what? Taxable temporary difference creates what? Creates a deferred tax ability. While a deductible temporary difference creates what we call a tax asset. When you are told to define what's a deferred tax liability, you are told to define what's a deferred tax liability. What's a deferred tax liability? Listen. Remember I said you will create a liability on the 6 million. Not create a liability of 6 million. I said you will create a liability on the 6 million to be paid in the future. That's what I told you. You don't create a liability of 6 million. You create tax liability on the 6 million. So, when you're told to define what's a deferred tax liability, you could say something like this. I've said don't write, shall put it down. But we are saying a deferred tax liability is the amount of the income tax payable. Amount of the income tax payable in the future, and which arises due to the existence. It arises due to the existence of what we are calling taxable temporary difference. It arises because of the taxable temporary difference. It is the amount of the income tax to be paid in the future, and it arises due to the existence of taxable temporary difference. When you are told as a deferred tax asset, remember I told you you are going to recover. I told you that? I told you are going to recover tax on the 1 million. You're going to save tax on the 1 million. When you are told to what's a deferred tax asset, even say it is the amount of the income tax recoverable. The amount of the income tax recoverable in the future, and it arises due to the existence of a deductible temporary difference. So those are terms you have been asked to define before. You're getting 2 marks, 2 marks, 2 marks, good marks. Okay, but we shall put them down next time. I will also go through this again next time. I'll also go through this next time, review the area, because this is where most of your past paper questions come in now, on the balance sheet approach, or what we call valuation approach. This is where most of your questions come in. I'll review what we have said so far, then I go through the other remaining items of balance sheet. Okay? Maybe for today we can stop there, pick it up from there next time, pick it up from there next time. See you next time. Hello? See you next time. Now, just as a reminder, listen, just as a reminder, I have already said that. I already said it at the beginning. Just as a reminder, please subscribe if you have not subscribed. Oscar said he had already subscribed. That's thank you. For the others who are watching, if you have not subscribed, please subscribe by clicking that subscription button. Just as a reminder, said anyone who is here watching this and would want to recommend to your friends about our online classes, said you tell them about advanced financial reporting online class for your advanced level, tell them about financial reporting of the intermediate and financial accounting of foundation level, that of ATD1, ATD2. I've said that. Mind them, tell them when is their financial advanced financial reporting. We have said early morning or evening, financial reporting evening. And I've also said if they are not able to attend a live class, said they can buy what we call what? Pre-recorded. They can buy what we call pre-recorded videos. They can buy what we call pre-recorded videos, where they can watch them at their own free time. They said somebody can contact me through this number, 0722 658875. Okay? Said currently we are charging 4,200. We accept payments on installments. Also said in case they join now, they can be able to watch the video of the classes that they have already missed. That's not a problem. That's not a problem. Good. I think that's all I've said. I think that's all. Now, unless I've forgotten, finally, if you have enjoyed the class, or if you have understood, if you have enjoyed the class or if you have understood, please click that like button. Click that like button. Show that you have liked the class for today. Hope you have understood something. So if you have understood or have enjoyed the class, please click the like button. Click that like button. Okay? Bye for now. See you next time. See you next time. Bye for now. Like the video by clicking that subscription button, sorry, that like button. Click the like button. Thank you very much. See you now next time. Bye for now. Okay. Bye too.